Good afternoon and welcome. Thank you all for joining us this afternoon for our Sales and Use Tax Planning 2021 webinar. My name is Miles Metzger and I will be one of your presenters today. I'm a state and local tax manager here at Mueller & Company. I have over 6 years of experience specializing in state tax with a high emphasis in sales and use tax, but also specialize in income tax and non-income taxes in states as well.
Good morning, everyone. My name is Arthur Kravchik. I'm one of the presenters today. I've been with Mueller for 6 years, and I'm a proud member of state and local team.
Thank you, Arthur. Before getting into our agenda here, we just wanted to cover a few housekeeping items. If you have any questions throughout the course of the presentation today, please use the questions feature in the webinar software, and we will do our best to answer those throughout the presentation. If we are not able to get to your question before the end of the hour, we will follow up with you via email to reply to your question. After the presentation, you'll receive an evaluation form to receive CPE credit for today's webinar. Please complete this and send it back to Mueller, and we'll provide you with CPE credit for today's presentation. We'll also provide you with a copy of the slides for your reference after today's presentation as well. Now, for the good stuff, what are we going to be talking about today for sales and use tax? We'll be going over a sales and use tax overview, what is nexus, taxability in states, exemptions, and particular exemption certificates that you can utilize, sales tax registrations and sales tax filing compliance, managing your prior exposure, any potential impact on your financial statements for those who use GAAP, best practices for moving forward with sales tax, and how we at Mueller can help you. With that, I'll turn it over to Arthur to kick us off for the sales and use tax overview.
Thank you, Miles. So we'll kick off with a few definitions. So what is sales tax? Sales tax is a transactional tax charged by the retailer on the gross receipts from sale or lease of tangible personal property, service, and digital goods to consumers. So sales tax applies to any seller who has or is required to have a seller's permit in the state and is required to charge the consumer sales tax on all taxable sales. Unless a specific exemption applies, like a resale, manufacturing, or nonprofit exemption. And as you can see, there's over 12,000 taxing jurisdictions in the US. So what is use tax? It's a tax imposed on the use and consumption of goods and services where sales tax was not charged from the consumer during purchase. So sales and use tax are complementary to one another. You're either paying sales tax at the time of purchase or self-assessing use tax once the sales tax was not collected. So the difference is the consumer has the obligation to pay and remit use tax on their own. This is most common when purchasing products and service from out-of-state vendors. So what is taxable personal property? It is defined as any property that can be weighed, measured, felt, touched, or in any other manner perceived by the senses. Few examples are clothing, retail goods, artwork, pre-written and canned computer software, gas and electricity. So what is taxable versus non-taxable? Again, taxable are any tangible personal property we just defined. Services specifically listed by a state as taxable, and digital goods. Non-taxable would be any property or services that are purchased for resale, property and services where an exemption certificate is received, or services in general are not taxable unless specifically stated, and purchase of real property construction services. So the general rule is taxable personal property is taxable unless a specific exemption applies, while services are generally not taxable unless specifically listed as a taxable service in the state statute. So what's included in tax space? Usually the sales price or the purchase price includes large number of items, as you could tell by the streamlined sales and use tax definition, but it also includes the transportation and delivery charges, installation, separately stated costs associated with the sale of tangible personal property, and any travel, meals, and lodgings incurred during the sale of the property. So basically, any charges necessary by a seller to complete the sale. This is a catch-all provision from the state. And one tip here is we recommend to unbundle charges and separate itemized items on your sales invoices. Continue with what's included in tax base. So discounts offered at the time of sale generally reduce the tax base. So you charge sales tax on the net sales price. Rebates, which are usually not received at the time of purchase, do not reduce the tax base. And then gifts and promotions given for no consideration are viewed by the retailer as being the end user because of giving the items away, and they must assess use tax. So how are sales sourced? So generally sales are sourced to the destination of where the product is delivered or where the service is being received. So if a shipper sends products to a customer, it will be based on the destination or the delivery jurisdiction. And if the customer is picking up products, the sale would be sourced to where the customer takes possession. And you could see examples: in-store purchase would be where the customer takes possession versus online purchase. Also, Illinois to Illinois sales are based on origin. And if the seller and the customer are both located in Illinois, then the sale is sourced to the location of the seller, not the buyer, even if the product is shipped to the purchaser. So basically, this means that the seller needs to charge sales tax rate based on his location. Next, we'll be covering nexus. So nexus is basically a sufficient connection between a taxpayer and taxing jurisdiction where the jurisdiction can impose its tax laws upon the taxpayer. So once nexus is established, the seller is required to register, collect, and remit sales tax. And these rights are given and governed by the constitutional nexus based on due process clause and commerce clause. So Quill versus North Dakota in 1992 was a fairly significant case. Quill was an office supply company that utilized mail-in catalogs to make sales across state lines without having physical presence in North Dakota. They took the orders out of state and delivered to North Dakota by common carrier. So basically, they didn't have any physical connection with North Dakota. North Dakota took Quill to court and went up all the way to the Supreme Court, where it was ruled that a physical presence was necessary to subject a seller to a state sales tax laws. So in this case, Quinn won, but the case became precedent for the physical presence requirement for sales tax. So if we jump to 2018, here's another significant court case between South Dakota and Wayfair, where it went up all the way up to the Supreme Court, and the court said that physical presence was no longer required for sales tax nexus. Before the decision, remote sellers generally not required to collect sales tax, but Wayfair struck down Quill and opened up the door to economic nexus requirements, meaning that if you benefited a certain amount of economic presence within a state, you can be subject to state sales tax laws. And from the Wayfair decision, North Dakota defined their economic nexus as 100,000 gross annual sales or 200 separate transactions. So what creates nexus? We just covered physical presence with the quote case. And as you could see, physical presence defined by having employees, independent representatives, inventory, including consigned inventory, leased products, and brick and mortar locations. There's also something known as affiliate nexus, where activities of a related party may cause the nexus for affiliate entity. Good example of that is in-state retailer accepts returns of books purchased from internet affiliate. And there's also another nexus called agency nexus, which is very similar to affiliate nexus, but it involves unrelated parties. An example of that would be in-state independent contractor fixes computers purchased over the internet. And then there's also click-through nexus. This is where an in-state business receives a commission for referring a certain amount of sales to an out-of-state seller through a website links. So an example would be a hockey club website link to an online retailer and receives commissions every time that link is clicked. And finally, we arrive at economic nexus, which we just discussed, referring to the Wayfair case. And the economic presence is from the gross receipts and transaction threshold alone without having a physical presence in the state. So keep in mind, physical presence did not go away with the next Wayfair decision. If you are physically located in the state, you still have sales tax nexus and filing requirements. What Wayfair did is added the complexity of determining nexus, where now it's more of a two-pronged test where physical presence and economic nexus both apply. So again, what is economic nexus? It's created by the economic presence alone without physically ever stepping into the state. Economic nexus focuses on the remote sellers. In currently all but 2 states, Florida and Missouri, have adopted economic nexus standards. A large majority of states followed suit, with South Dakota thresholds of $100,000 or 200 separate transactions. But most recently, there's a trend of many states starting to drop the 200 separate transaction threshold. The dollar threshold in many states applies to gross sales that includes exempt sales. And also, key point, Kansas does not have a threshold, so any sales by remote seller triggers a sales tax registration and collection and remittance requirement. So next is just a map showing which states have enacted economic nexus, represented by the blue states, and the gray states have not enacted economic nexus or imposed sales tax. Next is a list of economic nexus thresholds by states. So when determining economic nexus, you first want to review the state enforcement date when economic nexus thresholds were enacted, and then you determine if you hit the economic nexus thresholds. For example, Illinois enacted economic nexus in October 1st, 2018, and their threshold is $100,000 or 200 separate transactions. So if a remote seller sells to Illinois customers and meets these thresholds, then they are subject to Illinois sales tax laws and should register, collect, and remit sales tax. Also, more recently, the City of Chicago enacted economic nexus effective July 1st, 2021. They set the threshold at $100,000 of gross revenue. In Chicago, it has 2 separate taxes. The Chicago amusement tax, which is tax on streaming services, online videos, anything delivered electronically. and then also Chicago personal property lease tax, which is a tax on computer leases and software as a service. So next, we'll cover market facilitators. And market facilitators is anyone that provides a platform to sell other companies' products or services. So for example, Amazon, eBay, and so forth. Market facilitators are required to charge sales tax and are subject to the same economic nexus rules as most sellers. Marketplace sellers, on the other hand, are generally not liable for sales tax if they sell on, for example, eBay, because their obligation was shifted to the seller. Now, if all states are done through a marketplace facilitator, the seller does not need to register for sales tax. But you got to keep in mind that when you're calculating your gross receipts and transaction thresholds, the market facilitator sales done on behalf of the seller count into the aggregate of the meeting the economic nexus test. So market facilitators also consider inventory consideration. So depending on the relationship you have with your facilitator, you will either sell your goods and services to the facilitator and collect a resale certificate, which the transactions ends at that time, or consign your inventory to the facilitator. Now, having consigned inventory with a third-party facilitator also creates physical presence. So this means that the seller is liable for sales and other taxes where they have physical presence. Takeaway here again is the client could owe additional taxes related to sales, income, franchise, and network tax. So it is important to obtain records of where consigned inventory is located to understand your physical nexus footprint. Entity structure. So sales tax nexus is evaluated at the separate entity level where the sales are actually made. For federal purpose, disregard entities and consolidate into the group. But for sales tax purpose, if those entities make direct sales to consumers, they are evaluated for the economic thresholds for nexus to determine if they are required to register, collect, and remit sales tax. Foreign inbound entities. So treaty protection between the US and foreign nations is not always adopted by the states. And an important thing to remember is treaty protection only applies to income tax and does not apply to indirect taxes. So good planning key is before entering the US market is to determine what type of structure you want to set up in the US and what are your future plans to make sure that you're following the appropriate state tax rules. So if in the future, if you plan to sell off a business, issues won't come up in due diligence. So next we'll cover taxability. So what may be subject to tax? Things that are subject to tax are tangible personal property, services, if they're specifically listed in the state's provisions, computer hardware and software, digital goods, data processing information, fixed assets, and real property. So computer hardware, because it has a tangible component, is always taxable. Laptops, monitors, keyboards, things of that nature. Pre-written software is taxable in a tangible form. Computer software that is pre-written, also known as canned software, is not custom software. Now, not all states tax electronically downloaded pre-written software. So certain states look at the delivery method of the pre-written software, because historically pre-written software is sold on CDs. Now you have the ability to download it electronically to your computer. Also, custom software is not taxable. And what the features of custom software has to be developed for a particular user organization and must be created of new or custom code. Now, tip here is pre-written software configured to your specifications needs does not meet the custom software. So if you're purchasing that type of software, you still may owe you sales tax on the purchase. So software as a service is a software is leased by the customer and used over the internet. The customer does not have the control or management over the online software, so it's a straightforward lease, and taxability varies among states. Now, as you could see, the city of Chicago taxes software as a service at 9%, yet the state of Illinois does not. And the reason why Illinois does not tax software as a service is because majority of the providers follow the 5-part exemption software license test. And what is required in the agreement to meet this test is must be physically signed by the seller and buyer, and it has to be an actual signature. Check the box acceptance will not work. The agreement must restrict the buyer's rights to use and copy the software, prohibit the buyer from licensing, sub-licensing, or transferring the software, gives buyer the right to obtain another copy if the original is lost or damaged, and the buyer has to destroy or return all copies of the software once the license expires. So data processing is a process of or service of using computer to convert raw data into readable and usable form. And as you could see, the taxability varies among states. Connecticut, for example, charges data processing at a reduced rate of 1%. In Ohio and Texas, view data processing as in the same definition as software as a service, with Texas providing a 20% haircut exemption off the gross receipt price. Next is information services, and this is a service that provides general specialized news or current information. So examples would be our Checkpoint tax law research tool that Mueller uses. And the information service is generally taxable when not proprietary in nature, because the information is available to the public and provider is organizing it for the users. Proprietary information is generally not taxable because it's used information specific to a company. And next we have consulting services. So consulting services are usually defined as installation, implementation, configuration, help desk support, troubleshooting, training, and so forth. The taxability generally follows the underlying transaction. So hardware consulting is generally taxable because it's a tangible product. However, software consulting depends on the software and taxability within a specific state. So as you can tell, each state again has their own definition of consulting services. Connecticut taxes at a reduced rate of 1%. Illinois does not impose tax because it does not tax services. And Texas has a unique definition where if the seller sells the software and consulting services together, then the entire transaction is taxable, including consulting services. But if a third party is selling the consulting services without the software, then the service is not taxable. So whenever you're purchasing computer hardware and software, always ask the vendor to unbundle all the products and services and separately itemize the charges on the invoice, because sometimes the seller may get it wrong and not charge you the correct sales tax. And under audit, a few years down the road, state may come back and say that certain parts are taxable. Now, if the entire transaction is bundled and you can't separate them out, then the state will assess a use tax on the entire amount. So going on to digital goods, this is any product transferred electronically to a customer by downloading, streaming, or through other electronic means. And this is basically states taxing what they taxed in tangible format previously. As you can see, ebooks, digital videos, digital audio, and apps are being taxed by states regularly, because before the internet, they were taxed as tangible items. Fixed assets, again, are generally taxable unless a specific exemption applies. Fixed assets are usually defined by fixtures, furniture, capitalized software costs. On to real property. A real property includes land, building improvements that are incorporated into the building structure and are intended to be a permanent piece of the building. So sales of real property customers are not taxable. Purchase of materials incorporated into a real property by a contractor are taxable. And in most states, the contractor is viewed as the end users of the property they purchase. So they are subject to pay sales tax during purchase or use tax if no tax was assessed. Real versus tangible property. So states may treat sale or use of initial installation of property differently than subsequent repair or maintenance of property. So for example, installation of dry was generally viewed as becoming part of the real property, and the end user is not subject to sales tax. But on the flip side, installation of fixtures generally viewed as tangible personal property, so the contractor can charge sales tax to the end users. And again, if contracts include both real and tangible personal property, we would advise to break all those expenses out. And next is exemption certificates. So here are a list of exemption certificates that we'll be going over. So resale exemption certificate is when you take products and services and you sell them to a seller that will sell them in the exact format. The resale certificate could be a one-time purchase or continuous purchase, and is generally provided by a state-specific resale form. There's also additional forms that the seller could utilize. But generally, the resale certificate needs to be provided one at the time of transaction. So here, for example, is the Illinois CRT 61 Certificate of Resale. So for this document to be valid, all the steps must be completed, including the Illinois retailer and reseller account number in line 5, if the items will be resold in Illinois. And the seller is obligated to validate the Illinois account numbers, which could be done at mytax.illinois.gov website. So next, here's the MTC Unified Sales and Use Tax Resale Certificate. So this is a multi-state certificate that could only be used for resale. Now, we recommend to read the instructions carefully for all the states listed to make sure that the certificate is completed correctly and is valid. Next is a screenshot of this Streamlined Sales Tax Agreement Certificate of Exemption. Now, this exemption could be used for multiple exemptions listed in Section 4. And again, we highly recommend to read the instructions carefully when completing these exemption certificates. So what is this Streamlined Sales and Use Tax Agreement? It is an agreement developed to set uniform approach and simplify sales and use tax across state lines, and encourage states to enact legislation conforming to their sales tax laws. And as you can see, all the benefits listed for the member states. Due to time constraints, you'll be able to review these benefits on your own time, but SSUTA goal is just to set standard for all member states. Here's a map of all the member states represented in blue. And then there are sub-members that implement certain provisions of SSUTA. And the SSUTA Streamlined determine taxability? They do not determine taxability. Their intention is not to influence a member state to tax or exempt any item or service. That's up to the discretion of the state. They require member states to use the same definitions for products and services contained in their agreement and bring uniformity to sales and use tax compliance. And I will hand it off to Miles.
Thank you, Arthur. Another common exemption reason in states is manufacturing, or what some states will determine to classify it as industrial processing. The select states provide a sales and use tax exemption for manufacturing, and typically what's included in that is qualifying component parts, your raw materials, machinery and equipment, and replacement parts that are used in manufacturing. Now, one key takeaway here is that item needs to be, whether or not the state says directly, exclusively, or primarily used in manufacturing operations. So it's really important in states to understand the scope of the manufacturing definition, because items outside that scope typically will still be taxable to the manufacturer that are purchasing them. For example, Ohio and Illinois use a primarily used in manufacturing test, which is generally defined as greater than 50% of the time or more in manufacturing. Our neighbors to the north in Wisconsin use a direct and exclusive requirement and require that it be used 95% of the time, so a little more strict than some other states. Now we have the general definition of the manufacturing process here in Illinois, and typically it starts with the input of raw materials into a production process, and typically finishes with the transfer of finished goods to the first point of storage. One key item here also is that effective July 1st, 2019, the Illinois manufacturing exemption was expanded to apply to production-related tangible personal property. This aligns with more manufacturing exemptions in other states, and now that is included in that exemption, manufacturers can purchase consumables such as like solvents, lubricants, etc., without sales tax in Illinois. Now, I mentioned a little bit before the scope of the exemption, and this is really the crux about whether or not you as a manufacturer are entitled to that exemption. It needs to be used in qualifying qualifying manufacturing activities, and doesn't include those items that are too far removed or indirect from the process. So some examples of that would be finished goods storage. If you have racking in your warehouse for finished goods, that racking is generally generally taxable because it's not used in the manufacturing process. Also, if you have, say, a forklift in your shipping and receiving area that is moving, goods onto trucks for customers, etc., that typically isn't deemed to be manufacturing because the process has ended and now you're just getting product out the door. Be wary of mixed use equipment. I've seen a lot of manufacturers, for example, if they have a forklift or a crane that is doing manufacturing activities, but also used in shipping and receiving, that can sometimes taint that manufacturing exemption. That if you do have a mixed use, be mindful whether or not, especially in Illinois, if that meets the greater than 50% primarily used in manufacturing requirement. Another key thing here is, not all states have a manufacturing exemption, or they provide a partial exemption. You'll see we've got some states listed here that anything that a manufacturer uses in those states is taxable. I highly doubt there's a lot of manufacturers in these states because of that reason, but that's how the state adopts it. And also some states apply only a partial exemption for manufacturing equipment. Alabama, California, Mississippi notably provide a rate reduction, but not a full relief from sales tax rates. A big tip on this that I always say is, and we kind of mentioned this, is not all sales or purchases made by a manufacturer or purchases to a manufacturer are non-taxable. We really need to understand the scope of our manufacturing process and where it starts and where it finishes, because typically any purchases outside of that scope will be deemed taxable. For example, one thing I see a lot that this comes into play is typically, electricity and natural gas, if it's used in the qualifying manufacturing process, is non-taxable. However, that exemption that you're claiming with your utility vendor on there, you need to make sure that that doesn't include, creature comfort for overall cooling and heating of the building, that it's not the office or, admin areas, that exemption isn't taking that into consideration, because that can be kind of a battle under audit. Like I just said now, this is a highly scrutinized area under audit. State auditors always try to invalidate that manufacturing exemption to get more tax back to them. So really understanding the scope is very important. Other exemptions that are available in states are, agricultural or farming. Similar to manufacturing, it has to be used in a qualifying farming activity. Generally, sales to the government are non-taxable. The federal government is typically always non-taxable, which can be evidenced by just a purchase order. Typically, you don't need an exemption certificate from the federal government. State governments are generally non-taxable as well, along with local municipalities. Notably, some sales to state agencies can be taxable, Arizona, California, and Washington being those states. And then also nonprofit organizations. Typically sales to nonprofits are non-taxable. They'll provide you with a copy of their state exemption certificate. However, in California, it's taxable. One thing to note here for nonprofits as well is that you can be a nonprofit and your purchases are non-taxable, but if you're making taxable sales as a nonprofit, you still need to charge sales tax on any taxable sales you would be making. So Arthur kind of mentioned this earlier. What should an exemption certificate be in order to be valid? It needs the name and address of the purchaser and the seller, the description of the property purchased, the registration number of the purchaser, the reason for exemption, and it should always have a date, signature, and title of the purchaser. Now, one tip I can see here sometimes with more mom and pop shops is you'll ask for their exemption certificate and they'll send you a copy of their W-9 form. A W-9 form is not an valid exemption certificate for state sales and use tax purposes. That's more of a 1099 thing that sometimes gets set up in a vendor process setup. And a taxpayer FEIN can also not qualify as a valid permit number. So you really need to have that state-specific form or one of the pre-approved multi-state forms that we talked about earlier, and making sure that the correct permit number is on there. Illinois, like Arthur had mentioned earlier, is a series of 8 digits. A question I always get from clients is, Miles, do certificates expire? What do I need to do with a certificate? Now that I have it, does it last forever? Generally, the answer in state taxation is it always depends, but typically, yes. A certificate normally never does not expire in a state unless a state specifically expires it. So long as that information on that certificate has not changed, it typically is valid to continue exempting sales with that customer, so long as there are no changes to that. Notably, Florida is one state that most people are aware of, that their resale certificates expire annually as they are issued directly by the Florida Department of Revenue. So that's one that you'll need to collect every single year. With some few other states in here as well, that Louisiana, Michigan, and Washington, putting some expiration dates on their certificates. I believe Washington's another state that also issues their certificates by the DOR. As a best practice, what I always say on here is confirm with customers every 3 to 4 years if your exemption information has changed and you need an updated copy. That exemption certificate should really match what's on the invoice you're sending to the customer. So if that customer was either acquired or they restructured, they're no longer in business, they moved, all those considerations can potentially invalidate an exemption certificate if you do not have the correct information on file. However, if you would get in a situation with an auditor who does try to invalidate that, I would argue with them day and night on that, but they do have the authority to do that. So when do I need to collect an exemption certificate? Generally, taxpayers that are registered for sales tax in a state must charge the tax on a taxable sale unless they collect an exemption certificate from the customer. So you have the legal requirement now that you're registered to charge sales tax when your sale is taxable unless you obtain that documentation from your customer. Generally, if you do not have nexus in a state, you are not required to collect a certificate. However, as a best practice, I always recommend that you collect an exemption certificate no matter what if you have nexus or a filing obligation. This ensures protection in the event that a state auditor sends maybe a nexus questionnaire your way and tries to challenge your nexus stance in a state. And if the state auditor prevails and does assert nexus on you, you already have those exemption certificates on file to protect you. One question that I will get sometimes too is, can I question an exemption certificate from a customer? You know, am I able to accept it kind of no matter what? And generally the answer is yes. So if you're in a streamlined state, typically all the streamlined states say is that you need to collect that exemption certificate within 90 days after the sale. And so long as you do that, the onus is on the buyer, not you as the seller, for any additional tax that may be owed under audit. Even under audit, you can typically go back to customers and try to obtain an exemption certificate if you don't currently have it on file. One thing I just always say is use a level of professional skepticism on this. You know, if you have a daycare that is giving you a manufacturing exemption, you know, that kind of raises an eyebrow. That might not be correct. So just work with your customers on that if you notice something that's kind of odd, and feel free to reach out to us definitely with any questions on that. Next, we're going to talk about registrations and compliance. So now Arthur laid the framework down. We've got nexus, we determine if our sales are taxable, we collect those exemption certificates. You know, next step is kind of to do an exposure calculation, which we'll get to in a few slides briefly. But, you know, when do I need to register? What goes into registration requirements can be quite complicated, and how to complete that registration can be complicated depending on the states and circumstances and prior exposure. After we determine the data first nexus, really what is next is how does that estimated exposure play into this? Generally, taxpayers can move forward with a prospective registration, meaning like today's date or a more current date, if the estimated exposure is maybe immaterial, or if we quantify that exposure for prior periods and it rises to a level of materiality that is high risk for you as a taxpayer, we might need to take some alternative approaches to mitigate that exposure before registering. Because that registration requires the date that nexus was first established, it's really complicated to make, or it's really in depth to make sure that we're putting that in perspective when completing these registrations in states. Many states on these registration forms for sales tax have what's known as a penalty of perjury statement when you sign that registration, that if you as the taxpayer knowingly input false information on that registration form and sign that, you can be liable for fraud penalties in some states that are up to $10,000 on those registrations. So making sure that we finalize that date and what it should be, and knowing what our exposure is critical with registrations to avoid any doomage assessments from state GORs. You know, for example, you could say you had nexus in South Dakota beginning in January 2019, but you put today's date down on that registration and send it to South Dakota. I know for a fact that South Dakota is currently contacting any new registrants in the state and asking whether or not that date is correct, because if it's not correct and sales tax is owed for prior periods, they want that tax. So those are the considerations we need to be mindful of before entering into a registration with a state. Once you do have a registration, however, you now are required to file that sales tax return. States will assign you a filing frequency. It's either going to be monthly, quarterly, semi-annual, or annual. Typically, what states will do is they'll initially assign a monthly filing status, and then after a year, examine kind of like how much tax you're turning over, and then move you to a quarterly or annual as needed. You can file online through the state GOR website, or contract with outside service providers. So Mueller, we provide sales tax compliance services to our clients and actually work directly with Avalara on some of those. And Avalara is a pretty well-known sales tax compliance software provider out there as well. And depending on the complexity and how many states you're in, you may need to engage with a certified service provider such as Avalara for rate management that would connect directly with your ERP system to make sure that you have accurate and up-to-date rates in all states where you are required to charge sales tax. Now that we've identified exposure after we've gone through this, now what do we do with that? How do we manage that? Typically, we'll identify exposure through a nexus study, or we'll know just based on the client whether or not they have issues in states. And when we quantify that, that's when we make our decision of whether or not we move forward with the prospective registration or maybe some alternative remediation options. If we quantify that exposure and it's deemed material by you as a taxpayer, the risk is high in the state, or you know that you're going to be going up for sale soon, and it's going to come up in due diligence and a potential future sale, you're likely going to need to enter into what's called known as a voluntary disclosure agreement, or a VDA. And one thing I always point out on this too when we're talking about VDAs is if no return has ever been filed in a state, the DOR technically has the authority to go back to the date when Nexus was first established, since the statute of limitations has not started yet. So you could have been in the state, let's say 2008 was your first physical presence there, and you've had taxable sales ever since. Technically, the state can come back to 2008 and try to assert tax on you. However, in practice, many states will cut it off at 7, 9 years or so like that, but that is the state does have the legal authority to do that. A voluntary disclosure is going to protect you against that. So a voluntary disclosure agreement allows a taxpayer to voluntarily come forward to a state to relieve your prior period liabilities. Basically, what happens is you go to the state and say, you know what, hey, I realize I screwed up. I should have been filing in the state. I just noticed this from a nexus review. I wasn't due to fraud or, intentional evasion of tax. I want to come clean. Can you help me out and I'll limit my tax to 3 or 4 prior years and then give me a break on the penalties. And what happens is in that situation, most states will say, yep, that's fine, because the states are going to want the tax. You're voluntarily going to give them 4 years of tax and interest. They're on board to take that with you. You'll enter into this signed agreement with the state that'll limit the look back. It'll also abate penalties. Texas is interesting, they'll also waive interest. And it's available for all tax types, and your prior period past the look back period is forgiven forever. So that prior exposure goes away. You have a signed document from the state that says they are not going to assess anything for you to you on prior periods. And really the benefit of this too is working with Mueller, your CPA firm. We can do this for you on an anonymous basis. Then typically what happens is we request on your behalf and we represent you as the client, and it's on an anonymous basis. So you don't have to disclose who you are as a taxpayer and rat yourself out right away. So then they don't come and assess that for you right away. Typically we go forward anonymously, and then they'll agree to that agreement, and then we'll disclose throughout that process who the taxpayer is. Some big requirements on this though is that in order to enter into a VDA, you can never have been registered for the particular tax type that you're seeking relief from. If you ever received any correspondence also from the state DOR for that relief, so say you're looking for a sales tax VDA, you cannot have ever received any notices, nexus questionnaires, or audit requests related to sales tax. That will invalidate the VDA and you can no longer enter into that. Now, I have had success in the past that if we know this is an issue and we won't qualify for a VDA, we can try to go forward to the state and see if they will work with us and take alternative measures to try to get a relief on penalties. I have had success, but it's not always guaranteed. Your best bet is if you haven't had anything like this or any notices pop up, to enter into a voluntary disclosure agreement. Now, voluntary disclosure agreement or prospective sales tax registration, which one should we do? At the end of the day, as we say this whole presentation, probably it depends. It really is going to depend on your facts and circumstances. A lot of times on estimated exposure as well, your appetite for risk and your succession plan. One tip here is that if you are going up for due diligence, sales tax liability does typically not go away in an asset sale. Your sales tax will generally follow the underlying assets that are sold to the new owner. The only way to eliminate this exposure is really through a VDA. Otherwise, that exposure technically does exist forever until we remediate that. So that's a consideration that can come into play. If the estimated liability is high, probably material, and we're going to go with a VDA. If the risk is high, that's probably going to be a VDA. And it also depends on the state we're in. I think our analysis of how this would impact California, if you have activities there, is very different than how it would be in Wyoming. We got to take a lot of things into consideration here to determine whether or not we should move forward with a VDA or prospective sales tax registration. Quickly, we're going to touch base on the impact on financial statements for ASC 450 standards, formerly known as FAS 5. I'm going to disclose this, but I am not an auditor. I've never been an auditor by any means, but this is a particular topic that applies to sales and use tax that needs to be considered should any material liability be identified that is probable and reasonably possible. Basically, what ASC 450 says, it requires businesses to record contingent liabilities that are probable and can be reasonably estimated. Depending on how this plays out, A taxpayer may have to accrue the contingent liability on their balance sheet if they follow, this is all for GAAP too, accrue the contingent liability on the balance sheet, maybe a footnote disclosure in the audited financial statements, or it doesn't play out, it's not a concern, do nothing. And for purposes of time, I'm just going to skip this slide because we've got a chart that'll kind of ring in on this here. So really when we identify this exposure, so say like we do an exposure calculation, identify $100,000 of sales and use tax exposure in states for the past 4 years. Then what we need to do is determine, what's the likelihood of that loss? Is it probable, reasonably possible, remote? Can it be reasonably estimated? And then if you can calculate it as reasonably estimated, depending on probable, reasonably possible, remote, you may need to accrue or make a footnote disclosure. Now we would work in tandem with your auditors on that. If you're at Mueller, we would work with the auditors on that to determine whether or not that is something that we need to take into consideration, and they will help you with that. Now, if $100,000 sales tax liability may not be deemed material for audit purposes, but a $4 million one, that might be deemed material. So that's where we need to balance this with to make sure that we're not only complying from a state tax perspective, but for financial reporting purposes, that's up to date as well, because this will also come up in due diligence if you would ever go up to sale. I'm going to breeze through this here quickly. I know the purpose of this presentation is definitely to focus on sales taxes. That's probably the hottest area in state taxation right now. However, I always like to caveat that, when we register for sales tax in the state, that increases our detection risk for any other state tax that's out there. Whether or not that's an income tax, a non-income tax, a gross receipts tax, a franchise tax, we are now on their radar. They have our name, they know us, they're going to be looking for more now. So before moving forward with that sales tax registration, I always like to get a full picture to determine whether or not we need to consider income tax or other non-income taxes. One example would be Kentucky. I know that I had a taxpayer that registered there for sales tax, and typically they haven't imposed their minimum tax when you were only a remote seller, and they're now doing that. So if you register for sales tax in Kentucky, you're probably automatically going to owe a minimum $175 limited liability ending tax every year in Kentucky. Income tax, basically what this is, if you're protected under public law 86272, you're for net income tax purposes, you're not required to file a return. So that's solicitation of orders, tangible personal property, it's shipped outside the state and approved from outside the state. It does not apply to service providers. If you're a service provider, typically this does not apply and you'll have nexus in the state. Or if you are a seller of tangible personal property and you exceed solicitation activities in the state, then you might need to consider income tax. Income tax also has bright line tests very similar to the economic tests. For purposes of time, I'm just going to skip through this here. And here are some of those bright line tests that do apply. For example, California's index for inflation at 610,000 here. And note that public law would still apply to this test. So if you're a seller of tangible personal property only solicited in California and you meet the 610 threshold, you typically won't have to apportion income tax or pay income tax, but you will owe California's $800 minimum tax. Really the more important thing on this, I think, for when you look at sales tax registrations as non-income taxes, because these work similar to sales taxes where they're transaction-based or threshold-based. States are trying to broaden the tax base, and they're really enacting these new non-income taxes to get more revenue from out-of-state taxpayers. Here's just a list of very common state non-income taxes that we see, and depending on your activity in the state, you may owe this. Some of the bigger ones that I really see a lot are the Ohio commercial activity tax, the Oregon corporate activity tax, the Texas franchise tax, and the Washington business and occupation tax. These are all based on a measure of gross receipts in a state. You'll see that the threshold for whether or not you need to file differs a little bit in states. Ohio, for example, if you meet this threshold, you'll owe for sure $150 minimum tax, but then there's also a $1 million exclusion before you have to actually calculate your CAT liability. Similar to Oregon, you'll owe a $250 minimum tax if you meet this threshold. If you meet the $750,000 threshold in Oregon, you need to register within 30 days of meeting that threshold, or you're subject to penalties of $100 per month up to a maximum of $1,000. With Texas, effective for reports due on or after 1/1/2020, Texas now imposes economic nexus when you have 500,000 of sales in the state. For service providers, and particularly something to be aware of this year is they changed their sourcing methodology. So if a customer derives the benefit of your service in Texas, we may have to make some changes, and you're probably going to owe more Texas tax than previous. Washington B&O, they modified their threshold to 100,000 as well to get in line with their sales tax. They're filed on the same return. And Washington is probably one of the most aggressive states out there. If we aren't filing this in Washington, it's something we need to consider because Washington imposes 39% penalties on this tax. So the liability can be quite hefty depending on your activity. Now we're going to get into some best practices. I know we've got like 5 minutes left here, so I'm going to try to swing through these quick for everyone. Really, with taking all this into consideration here, what is the best practice? And there's lots of moving parts. What's our takeaway? And at the end of the day, how do we manage this? The goal is not, to pay tax correctly to every single jurisdiction in the country. I think that's impossible for taxpayers to comply with because laws are so complex in states. But what we need to do is manage this process to make sure we're at least aware of it and we know what to do should a state come knocking. Really, my overall best practice is if you don't have a nexus study and you're concerned about your multi-state impact, we really need to look at a nexus study. It's especially more important for taxpayers that are going into due diligence, and that'll be your get out of jail free card in that situation. But a nexus study will identify your entire state footprint and your potential exposure, and then that's really how you monitor and manage this on a go-forward basis. In other instances, making sure that we're requesting that exemption certificate documentation from all new customers and like the initial setup. Sometimes that's easier to do right away rather than chasing them down for that while you're setting them up in your system. Reviewing those exemptions for validity, refreshing those every 3 to 4 years, making sure nothing's changed. If you haven't obtained any exemption certificates from your customers yet, I definitely recommend you need to do an exercise to get that information through what I would call an XYZ letter. Typically, that is you sending a letter to your customers or an email that says, hey, we're updating our records. Can you please provide us with a copy of your exemption certificate for your file or confirm that we should be charging tax to you? Another one that Arthur mentioned too is, taxability study. Taxability is huge. If we have nexus and it's not taxable, then it's not really an issue for us if we're not selling anything that's taxable or our customer base is non-taxable. However, if you are selling services that are taxable and you need to register, we need to be aware of that to make sure that we're managing that and charging tax when appropriately. This is especially prudent for anyone in the computer software space because that is just a very hot area in state tax audits right now. Engage with those software providers out there to provide those real-time tax calculations. Avalara, Sovos, other ones can provide you that rate update right away and it attaches to your ERP. Estimate any of your sales tax on the POs or project proposals that you're going to charge when you receive these from customers. A sales tax payable GL account, I normally recommend separating these by state. I know that can be kind of burdensome to have it each by state, but having a state separated GL account for sales and use tax will ensure that if a particular state audits you, you know exactly what ran through that particular state account rather than one accrual. And just understanding the risk, that's what you're all doing here today is, being educated about what the risk is in states and, how states are trying to tax this more and making sure that we manage it through, your tax professionals. For use tax best practices, similar to sales tax, separate GLs for use tax in states. Normally, you'll see more of a use tax requirement in your home state than any remote states. Enact a review procedure for those large fixed asset purchases. Have a dollar threshold, maybe that if it rises to that level of materiality, AP takes a closer level review at it. A policy for expense reimbursement, making sure that you get that receipt that has the sales tax charged on it so that's your get out of jail free card in an audit. If you have credit card purchases or procurement cards, making sure that those individuals who are using those also provide a copy of that receipt that has sales tax on there. In an audit situation, the auditor may pick up American Express from the sample, and then that American Express statement doesn't have any sales tax on it, and you need to prove that all those transactions on those statements, sales or use tax was paid. Proactively providing your exemption certificate to vendors if you're purchasing for items for manufacturing or resale. Software, software is huge right now in state sales tax. That is probably the biggest area of exposure. Unbundle those transactions, whether you're the seller or the purchaser, making sure that you understand what is taxable. If you have service coupled in there, is the service taxable? Help desk support, it's a huge area to consider. New construction builds, if tangible, what is the difference between real property and tangible? If you're selling it, you need to charge. If you're purchasing it and there's TPP embedded in there, do I need to assess use tax? Unfortunately, use tax is still a very manual process, but there is some software out there that can help. But due to the facts and circumstances, and that one little thing can change something, it can be hard to get software to comply on this. And real quick here, what can we do? At the end of the day, we've got a minute left here. Our goal at Mueller and SALT here is we want to just manage this for you to make sure that you don't get a surprise in the mail one day. there's always a technical answer. What's the correct thing to do for a state? But really, a lot of this is looking at it from a business perspective. What's the risk? What's the cost benefit? I've only got I meet the threshold in Wyoming, or I had physical presence there for one day, but maybe we can pass this Wyoming because we don't really hear much from Wyoming. It's those types of things we need to manage to make sure we're accounting for. We can do a variety of things for our clients and anyone else here on the call. A nexus study, as I mentioned, looking at it from all state taxes or sales tax only. That taxability study to analyze your revenue streams. Sales tax registrations, I always recommend contracting with an outside service provider to help with that because they are very complex and one little checkbox can change a multitude of answers depending on that registration. Return compliance, we work directly with Avalara to prepare our returns and prepare that with their software to ensure the most accurate and up-to-date reporting. Voluntary disclosure agreements, partnering with us as the provider to make sure that you're going in on an anonymous basis to not disclose you to the state. The policy and procedures review, really looking at your current process, what needs to be tweaked, what's working well, what can we work on, and what should we be thinking about in the future. Due diligence assistance from any state tax perspective. Maybe you need a customized training. You have a specific industry that you want to educate your AP professionals on. That's something we can help with too, along with audit assistance and notice response. Well, we went right up to the last minute here too. I apologize. We don't have any time for questions right now, but we will monitor the questions. Oh,
Miles,
sorry, go ahead, Arthur.
I think we could stay on for a few minutes to make sure we address everyone's questions.
Let's see here. I think I'm only seeing one right now, so I'm not sure who this came through, but I'm just going to read this offline here. So, sales versus use tax. As a vendor, we are selling delivery services to company X for medication. These devices have been given at no additional charge to customers when they purchase the medication. As a vendor, we're supposed to collect sales tax. Is company X responsible for the use tax that they should be collecting from the end user? I believe it is company X I believe you should be the self-assessing use tax on there. But I just want to, before answering this out loud to whomever asked this question, we'll send you an email follow-up on this for sure.
Hey, Miles, there are about 7 or 8 questions in the question chat. Did you want to go through them now, or would you prefer to address them after?
I'm only seeing one in mine, Ashley, so maybe let's just go, if we can just address them after, we'll follow up via email. I apologize.
Okay.
But yes, if you do have any other additional questions, anyone, mine and Arthur's contact information is here for you. We'll be sending the slides to you as well. And anyone who inputted a question in the chat, we will get back to you this afternoon with an answer to those questions. Thank you very much for your time and attending today. We greatly appreciate it and look forward to working with you all in the future.